we've ever had in the last 75 years. And in the period of time that we had this recession, Mr. Bernanke, you remember, basically leveraged us and basically went into more debt to get us out of this recession. And so he did the first, the second, the third economic easing, and he took the balance sheet and went and raised it from $800 billion to $4 trillion, and he took in all the banks that were going under, and Lehman Brothers and Bear Stearns, and he helped General Motors and AIG and everybody and anything. And the rest of the world was laughing when we were in this recession, thinking they were on a roll, and Europe was doing just fine. Everybody said maybe the euro should replace the dollar going down in value, the euro going up in value. We had all of the emerging markets. You had India, China, Brazil on fire, and all the oil countries out there. Oil went up to $107 a barrel, so they were riding high and full of cash. Well, about a year and a half after we were in this recession, we all of a sudden get some rumblings that they're not doing so well in Europe. And they have gone into not one, but two recessions, and it's all about the big countries, Portugal, Italy, Spain, Ireland, and Greece. And the biggest one, obviously, that we keep hearing about is Greece, because they keep needing money. They keep going back to the other members of the European Common Union, and they keep asking for loans. Yesterday, they were rioting in Athens, and basically putting the city on fire because they don't want to live on a budget. Because every time the other countries give them money, they tell them what you have to do is go back home and you have to live on a budget. They don't want to live on a budget. So there's a lot of trouble there, and they're in a second recession. When you look at basically countries like China, they came out 2-3 weeks ago and said they're not going to grow at 12% this year. They're only going to grow at maybe 5 to 7%, and that shocked the world because China is supposed to be driving the engine now. They're buying all the commodities of the world, and they're supposed to take us every place we need to go. In Brazil, the real is down 30%, so they're having tremendous inflation and they're having problems. And oil today opened at $41 a barrel, barely holding $40. Therefore, at the end of the day, there goes all the countries that were used to that $107 a barrel. So you have a lot of stress and a lot of chaos going on around the world with everybody doing different things. Now, let me talk a little bit about China, because that's an important one. China now says they're not going to be at basically 12%. They came out with their second quarter results. They were at 6.9% growth. Here's what's happening in China. China got to be a world leader by being the largest exporter in the world because they were the low-wage leader. They decided that that wasn't the way to sustain themselves. They have 2 billion people there, so they wanted to take an outside economy and bring it inside and let the 2 billion people that live there basically support the economy. So they decided that they would get into the housing business about 2 or 3 years ago. And here's the thing, in China nobody owns the land, the government does, so you can own what's on top of it, but you can't own the land. And they went on a building spree like you couldn't believe, with condos and apartments one after the other, and they have no lending, they have no basically title, they have no basically kinds of rules and regulations regarding home ownership, and so everybody's buying everything, and 15 people are buying the same condo, and basically people show up, they like it, they don't like it, they live there for a while, they leave, the buildings fall down because the quality's so crappy. So there went their housing market up 80% and it fell. So they decided, well, that didn't work, so why don't we try a stock market? That would be great. We'll try a stock market like the New York Stock Exchange, and a year and a half ago, they did that. So what did they do? Well, the government owns all the companies there, so they just threw 90 companies on their stock exchange, opened it to the world, and said, come one, come all, now you can buy all these companies, they're going public. Well, the problem with that is they have no SEC, they have no quarterly filings, nobody has any transparency, nobody knows who owns the company. Is it still the government? Do you owe money there? Do you have to pay money there? Are you ever going to get your money back once you put it in? And so their stock market went up 80% and flew back down and went down 40%. So we've had the shock of that coming into our stock markets and the stock markets around the world. Now, we compound that with what's happening here. Our national economy, how are we doing? We're growing at about 2.5%. First quarter was 0.25% GDP, not very good. Second quarter, they said, was 3.7%. This last quarter, we only grew at 1.5%. So we're going to still be stuck at that 2.5% level. We can't get to 3%, which is where they would like us to go. Now, there's a lot of reasons for that, but the biggest reason is it's not just a recession anymore. It's a structural change in the economies of the world. So we have gone from manufacturing, construction, and a real strong middle class to the fact that now the industries that are going to bloom and blossom, and that's why you have a good, decent real estate market here, are going to be technology, they're going to be energy, there's going to be healthcare, the financial industries, the bio industries, and the biotech industries. All those industries are the ones that are going to bloom and blossom. And what has happened because of that is you're going to have people at the lower end incomes who are what we call the worker bees. And then you're going to have people who have higher incomes because they have the education and skills that these new industries need. And the middle sort of fell away and went away. And that's what the whole world is trying to adjust to, and we're trying to adjust our economies based against that. Now, let's continue. When you look at the national economy, all of a sudden we're fighting with the rest of the world. The dollar's going up, oil's going down, gold is not in a good place. And all of a sudden, it's time for us in second quarter to talk about our earnings. So the first one that comes out is Mr. Iger, who's the gentleman from Disney, and he's talking about Mickey Mouse and Minnie Mouse. And you know, he says, man, everything is wonderful. The Avengers, a $2 billion movie. We had Frozen, basically owns the world, and if I hear that Let It Go one more time, I'm gonna kill myself. Then you have basically Star Wars coming, so you're gonna get that ad nauseum, and all the seats are already sold. And he talked about the cruise ships and the hotels, and everything is wonderful. And then he gets to ESPN, which is their sports cable division. And he says, you know, we're losing subscribers at ESPN, and that's not a good thing. And they took that stock down $10 in 1 hour. So now we have this slightly overvalued stock market because people had made 20-25%. Now remember, when we started the recession, the Dow went down to 7,000. When Mr. Iger got up to basically give his report, the Dow was at 18,500. So everybody got back everything they lost plus. 2 days later, Tim Cook gets up and he's talking about Apple. My God, Apple. The phone, the watch, the TV set, everything from Sunday. And he says they have $155 billion in cash sitting in their coffers. Life is wonderful. And by the end of next year, they'll have another $70 billion in cash. Now see, when you have that kind of money, you can do anything you want. You can do applications, you can buy people, you can bonus them, you can do stock options, you can do dividends, you can buy companies, you can buy back your stock. And one of the analysts says to him, well, Mr. Cook, where are you going to get the $70 billion? And where's the growth going to come from? And he says, oh, it's going to come from China. Oh boy, that did it. China now is not going to grow so fast. No one will ever buy an Apple product. Here we go, life is not wonderful. Let's go back to China a minute. On November the 11th, they have a day in China called Singles Day. And it's the no Valentine Day. So if you don't have a Valentine and you're single, this is the day that you go out and you buy something. Alibaba, which we've talked about before, one company did $13 billion on November the 11th. They processed 86,000 transactions a second, not a minute, a second. And basically the average price that people bought was about $33. Now, Mr. Ma was on CNBC. He was very happy about the $13 billion, very unhappy about the back room. He said 86,000 transactions per second isn't good enough. He wants 100,000 transactions per second by next year because that's what he needs to accommodate the buying that went on around the world. So one, you don't have to worry about China because believe me, they're in good shape. They're taking a little hiccup, but they will be fine. Now everything calms down, but here's what happened. In this process that we talked about, we've lost $5 trillion in the stock market, and basically we've gone from 18,005 down to about 17,002. So the market is in correction territory, and we are not positive for the year. Now, every day since then, we've been going up and down, up and down, up and down. It can be 500 points within 1 day, within 1 hour, within 1 minute. So everything sort of calms down. The last 2 weeks have been pretty good. And then we get the word that Germany's down 4% one morning, and that's because of Volkswagen. Now, Volkswagen is the largest car company in the world, and they decided that they were going to develop a car that would be the most fuel-efficient and pollution-free car in the world. And they did that through their diesels. Now, there's 14 million of them on the road right now, 1 million of them in the United States of America. Here's the problem with them. You can be fuel efficient, you can be pollution free, but you can't be both together. So they developed an engine and sold it to everybody that way, except it didn't work. So what they did is they put an application on the engine, so when you're driving, you're fuel efficient. When you go get your smog test, a little button switches on and you become pollution free, but you're not fuel efficient. And what they found out is this car actually pollutes the air 40% more than any other car on the road. So now they're going to get fined by the government. But look at it this way, you now have a car that's polluting the air 40% more than any other car you're driving against. Do you want to drive that car? No, you don't. Is there a fix? No, they don't have one yet. So you want them to give you a new car, and there's 14 million of them on the road. You also have a car that you can't give to a charity, and oh, by the way, if you live in California next year and you're driving one of those cars, you will not get from the DMV a registration, and you will not get a new license, basically, ticker. So basically, they're in big trouble with Volkswagen. So that brought down the world and brought down Germany 4%. Now, everything looks good. We're going back up. We went back to 17,008. Everybody says it's over. The correction's done. Life is wonderful. Last 3 days, the market has gone basically the other way. We were down almost 300 points yesterday. Why? Because of Greece, number one, because of some of the unrest that's still around the world, because of, and this is the biggest one, what's going to happen to Fed rates. Now, we know that. Now, how we're going to hear about it ad nauseum through now to December. She didn't do it in June, she didn't do it in September, she didn't do it in October. Is she going to do it in December? Here's her problem. No matter what she does, somebody's going to be unhappy. You do know that. Retail numbers have come in, they're lousy. They brought Macy's down and Nordstrom's down $10 today because Nordstrom had bad earnings. The industrials are looking okay. The financials are looking decent. So we have a very mixed kind of numbers on the national level. So she's looking at that, and we have no inflation here, yes, but not around the rest of the United States. And so probably she's saying, I should probably wait maybe. The rest of the world is pushing her to wait, but a lot of people are pushing her and saying, we've been on this sugar now for 9 years, it's time to get off the sugar and we gotta get moving here. So at the end of the day, she can do it in December. If she does that, we're all going to take a hit. She's going to be the Grinch of Christmas, you know that. And at the end of the day, will she do it? I don't know. If she doesn't do it then, for sure she's going to do it in March. So it's just a question of months. And it isn't going to make any difference. It's going to be 0.25%. We can take it, we can handle it. And you know what? She has to raise rates very slowly because the whole world is in debt. It's leveraged, and they have to keep interest rates low so we can keep moving in these economies of the world. But you're going to hear ad nauseum about that. The other thing that everybody's wondering about, of course, is this wonderful election that we have. And somebody asked me yesterday when I was doing a presentation, who's running for president? And I said, nobody. Nobody's running for president. So at the end of the day, on one side, you have the Pillsbury Dough girl. You have Bernie Sanders, who went to Russia and never came back. You have somebody else who I have no clue who it even is. On this side, you've got 89,000 Republicans running. Nobody knows who the hell they are. And you know what is amazing in this world? If 10 years ago you had said, the three biggest contenders in the Republican Party who are running for this office, nobody even hardly knows them. Now they do. And none of them have had a political career. So you have Mr. Trump, the entertainer, you have Dr. Carson, who's a brain surgeon, and you have Carole, who basically was at HP. So at the end of the day, I have no clue who's going to be president, but I think this is going to be what we call America's fun election. That's what this probably is going to be, because there's nobody serious out there. When commentators and debaters are asking questions like, who's your favorite comic? I think that we're basically in a little bit of trouble. So at the end of the day, that's what's going to happen, and I guess we will get a president, and God only knows who it will be, and it'll be ad nauseum, and you're going to hear about it from now till then, you know. So now let me talk a little bit about the economy here. The economy here, guys, is totally different. Here we're growing at 6-7%. They're hiring people as fast as they can. One of the biggest things that just happened is that Apple bought in East San Jose 43 acres of land. And all the other companies have been doing what they call land banking, which is grabbing land as fast as they can all around Silicon Valley. In San Francisco, they're grabbing all of the space they can, whether they're renting it. And out here, they're going to start to build manufacturing and distribution, and that's the key for you in the East Bay. That's going to allow people to get over here, live over here, and not have to commute to the other side, thank God, because we're congested. Now, Apple, just to show you what kind of power that these companies have. This parcel of land, and if you have an investor and you want to know where to go to the East San Jose area, where 880 is and where it meets. And basically there's a triangle there, and they wanted that land because they said the basically spaceship that they're going to build, that's going to be 2 million square feet, is going to be filled before it's even built and finished. So they wanted enough land to build a second campus, because they don't just go into an office building, they want a campus, a whole city environment. So that land was up for $50 million, and a Chinese trust came in, and they were going to pay $60 million for it. And basically, Apple came down and said, look, we want to buy this land and we want to make it real easy for you because we're not getting into a competition. So you know what we'll do? We'll just give you $143 million for the land and we'll call it even. And that's exactly what they did. So you begin to understand the power of the kinds of money that they have there. So when people say to me, but how can this continue, Carole? And how will people be able to afford it? If they want an employee, and that employee is important to them, and that employee needs to have a certain salary in order to stay here, they will give it to them. If that employee comes to them and says, you know, I can move to Texas, and in Texas I can do what I'm doing here, and I can live in a 4,000 square foot house, and I can make a much better, basically, kind of life for my children. They can go to a private school, etc. They will make that come true for them here too, because they have so much cash. So let's talk about it. Apple, 155 billion. Facebook, 60 billion. Google, basically 55 billion. And then you keep going on down and you're talking about trillions of dollars that they have sitting just in Silicon Valley with more pouring in. Now let's talk about another reason why you're going to continue to have a good real estate market. We are in the disruptive phase of this economy, which is when traditional old industries go away and new industries come in that create great wealth. So we've talked before about Uber, that's obviously taken on the taxi cab industry, and think how profitable a company like Uber can be. They don't own a limousine, they don't have to maintain it, they don't need insurance, they don't need a lot of staff. What they use is the internet, which is free for everybody. So they're a connectivity company. They take you when you're calling on your phone and connect you with somebody who basically can drive you wherever you need to go. And they do that through a pipe that's free, and they get a fee for that. Airbnb, the same thing, and it was in the paper this morning that they're going to now start classes for people who will have people in their home to tell you how to be like a hotel and set up the environment, so you leave towels and you leave shampoo and you leave all the things that people need. There's a new one out there called Heal.com, H-E-A-L. That's a group of assistants of nurses and physicians in San Francisco and Los Angeles that are going to be taking on the hospital industry. And what they're doing is they're saying if you are someplace and you fall down and you break your arm and or you basically have the flu or you're sick or you're nauseated and you call us, we will send you guaranteed within an hour a doctor and a nurse to your home that will basically look at you, take care of you, and they will do that for a flat fee of $99. You don't have to go to an ER room anymore. So you understand what we're saying about this disruption, which creates great wealth. Because see, in the old days, if you were an Apple and you're paying 50 people, and here's the average salary at Apple, about $150,000 to $170,000 a year, that's a tremendous overhead. And if you were in competition with a company like McDonald's, they have 300,000 employees, but most minimum wage, you're going to find that McDonald's would have been much more profitable than an Apple because of the labor. But today, in today's world, an Apple is much more profitable because they use applications and software on a pipe that people are, one, willing to pay a premium for, and two, their cost structure basically accommodates 40% profit on everything they make. Over here at McDonald's, why they've been having some bad earnings? Because they only make 3 cents on every hamburger that they're schlepping out there. And they got to do a lot of those to make some kind of a profit. So at the end of the day, you understand this disruption creates great wealth. And the internet and the way we do business now creates great wealth. And we are sitting in Technology Center, Silicon Valley, absolutely perfect. Now, it's amazing how these millennials have reacted to this stock market crash that we've had. You know, I think there is a God, and I'll tell you why. Because these millennials, these 25 to 45-year-olds, some of them have been so arrogant and so nasty and so difficult to work with and think that they've owned the world, and they do. And I think the reason for that is we mother coddled them from the day they were born. We told them they were wonderful, perfect, bright, intelligent, they would own the world, they could inherit it, we were going to give it to them when they were young, and if they didn't make it while they were young, we would die and leave them all our money, so therefore they would inherit it. So it's kind of fitting in a way that they're a little bit panicked. So I have a couple of kids that are millennials, and one of them calls me up and says to me, you know, did you see what happened, Mom? This is a disaster, this stock market. Oh my God, I don't know what I'm going to do. This never should have happened to our generation. This is just not right. You know, I got a wife, the Botox wife. I got 2 kids in private school. I got a big house. I got 3 cars. I got a nanny. I mean, my God, what's going to happen here? This is just impossible. And so I said to this child, you know, you shouldn't be worried about what you lost in the stock market. You should be worried about what I've lost in the stock market, because here's the way it's going to work. You're still going to have the Botox wife and the kids in private school and the house and the nanny and the cars. If I lose all my money, I'm also coming to your house. And I'm a lot more expensive than anything you got that you're living with right now. And with that, I said, bye, and I hung up the phone. So it's kind of fitting, right? It's kind of a good thing. So now let's go back to the real estate market and how they've reacted to all of that. Because at the end of the day, here's what the statistics show us. Millennials now will be your biggest buyers of real estate. That's that 25 to 45-year-old group. They're bordering 32% here. You're going to get a lot of foreigners here also too, because especially with China and the slowdown, they want to get their money out of there as fast as they can. So you have a different kind of client than you had, let's say, 10 years ago. And obviously some will be at the first level, buying the first home. Some will be at the middle tier, moving up and moving around, people that have been here and finally have enough appreciation that they can move up and move around. And then you're going to get some who come in that want to get into the affluent market. But let's talk about what's happened to real estate. Let's go back a little bit. What has amazed me about real estate is this. If you go back 3, 4, 5 years ago, nobody liked real estate. And in fact, you were in the East Bay in an area where you went down between 40 and 70% in the value of your homes. Now we can agree that there was a bubble, and that bubble in the year 2000 basically created overvalued real estate because of the easy lending and the fact that there was not true value there. So let's say of the 40 or 75% that you lost, half of it was basically never there to begin with. It was all a perception in someone's mind. But that meant that you still went down 20 to 40% in true value of real estate. Nobody wanted it. You couldn't give it away. You had so much inventory, foreclosures and short sales. Now sitting here today in this room, don't you wish you all had bought every foreclosure and every short sale that was out there at the time? And yet we didn't do it because they said, oh, it'll never come back and I'm scared. Why would we think that living in the San Francisco Bay Area? See, maybe if you were living in Fargo, North Dakota, I could buy that. But I can't buy it in San Francisco, California, an international city, gateway to the Pacific Rim. We have Stanford and Cal. You have Silicon Valley, cultural diversity, employment diversity. You're going to have 2.1 million more people here by the year 2020, 2040, and you're going to have 1.1 million more jobs. How come we didn't get it? Not only didn't the clients get it, we, the real estate people, didn't get it either. All of a sudden, we go from, it's the worst asset that ever was, and all of a sudden people are looking at different things like the bank, which gives you 0.25%. Interest rate now is at 0, so you can get in for 3, 4%. All of a sudden, real estate now becomes a more darling asset. Now you have a whole client base that they already own stock. They're getting stock every day of their lives that they work at these companies So they're saying, well, I don't maybe want any more stock. I want to start to build wealth by diversifying my portfolio. So you know what I'm going to do? I'm going to buy real estate. Oh, and by the way, we now have all these foreigners coming with money, and what do you think they're going to buy? They're not going to buy stock. They don't need to come here to buy stock. They're coming here to buy real estate. So we go from the dregs of real estate to, oh my God, everybody started to love real estate, and it becomes the darling asset. And the last year, what you've seen, multiple offers, competition, no inventory, low interest rates, buyers running to real estate to buy it as fast as they can. Now what's happened, and has there been a slight change? Yes, I think there's been a slight change in the market. And I call this market sticky and spongy. And I'll tell you what I mean by that. What I mean by that is where buyers were running in the last market a few months ago, because of the stock market, they're still ready. They love real estate, but they're standing and watching. And they want to see what's going to happen to the real estate market. Is it going to correct like the stock market? Because it's not over till the fat lady sings. And the stock market and the decline and the ups and downs aren't over yet. We might end the year positive, but it'll be very mild, single digits. I think that basically that's the way it's going to be. And I think it's going to go into 2016 the same way. So here's what I think you have to do. With buyers, you have to reassure them, because here's the questions that we're getting. There's another bubble coming, right, Carole? No, there's not another bubble coming. Now see, here's the problem. You can define the real estate market currently any way you want, but they all use the term bubble because that's what they've been trained to do from the last downturn that we had. And what you need to say to people, bubbles are bubbles, and there's different kinds of bubbles. The bubble that we had in the last downturn was the result of a bad economy, bad employment, we were in a recession, people hated real estate. So now you want to call it a bubble? Do that. Good economy, people have jobs, nobody gets to buy a house unless they put money down or pay cash. Oh, and by the way, we've had appreciation and things are holding. So at the end of the day, you call it what you want, you may call it a bubble in a bubble, but there are different kinds of bubbles. That's the first thing. Carole, this market's overvalued. Overvalued? Well, overvalued means you have a lot of inventory, high interest rates, a glut of people in the market that basically can't find anything, and everything is going down in price. We have none of that right now yet. Inventory has grown slightly, but it's not a glut. Interest rates are still low, and guess what? People are still out there trying to buy real estate and wanting the asset and loving it. So those terms that people are using, and you're going to hear it from your buyers, you have to sit down and re-explain it to them. Here's where they are, however. They have the best market they've ever had in the last 5 years. The dreg market they didn't like. They should have liked it, but they didn't. The market that they've had the last year has been one of competition and frustration, and that one's been difficult. Here you are, Mr. Buyer. Inventory has grown, so you have more choices. Interest rates are still low. You absolutely have the opportunity to get in an asset that we know is still appreciating. Now, maybe it's not going to appreciate 20% like it did last year, but every place that we look, if you hold the price correctly, it's still appreciating, and it'll probably be single digit by the end of the year. That's not a bad thing. And then you can also get in and probably, for the first time, do some terms and conditions. Oh my God. Now that's how you have to sort of talk to buyers. They need a re-education of where we are. This is not a market in a downturn. This is a market that's sticky and spongy and is hesitating and pausing a bit. Now what do you tell sellers? They're the ones that are going to muck your market. They're impossible, okay? One, they're impossible because they live in the world they want to live in. Now, they're going to tell you, but this house sold last week, and I heard one here today that said 550, and so they want it to be 575, okay? And they think that they push appreciation by pricing it higher than the next one, or pricing it so low that it's going to go with 9,000 million offers over. Well, here's what's happening, guys. It's very good at the lower end, decent at the middle. The higher end is already beginning to crack a bit. We're seeing price adjustments and days on the market longer. That is not a good thing. If it filters on down, you don't want it to do that. So I think what you need to say to sellers is, this is a different kind of market. Where buyers were running to us now, they're standing and watching, and so we need to be well priced to sell in this market. Well, what's the well priced, Carole? I don't think it's the comp you had a month ago. I don't think it's basically what you're seeing listed right now. I think it's what your gut tells you. Now, if you're going to price it under where you think it should be, here was always the game. We're going to get multiple offers. You cannot promise that anymore, because I guarantee you what we're seeing on the other side of the bay, where they used to get 10 and 12 offers, sometimes they're only getting 2, sometimes they're only getting 1, and sometimes they're not even getting an offer, all right? Also, everybody that used to say we're going to hear offers next Friday, don't do that. Because what's happening is, on Friday, you're sitting there waiting for offers, and you know what happens? No offers come in. Now you've got to call your sellers and tell them, gee, yeah, you thought we were going to get 10 offers because somebody took 12 disclosure packages, but nobody came to the plate at the end of the deal. So you need to re-educate these sellers that we're in a different market. That doesn't mean it's a bad market. There's never a bad market. When we were in the dregs, it wasn't a bad market because, listen, somebody made a lot of money with foreclosures and short sales, all right? We've lost $5 trillion in the stock market. We didn't lose it. It just went to the other side of the table. That's all that happens. There's a buyer, there's a seller. It depends where you sit and your timing, whether you're on the winning side or whether you're on the losing side. So we need to re-educate these sellers that you need to price your property to sell. And here's the thing, they cannot languish on the market for a long time. These millennials do not like that. Now the other thing that's going to complicate your life is TRID. And I call it the reason I drink. Now, this is the infinite wisdom of the government. 1,488 pages long of a bill that's supposed to help the consumer understand lending better. There isn't a consumer here, and your mortgage people could tell you, the bank people there, that would understand lending if you sat down from now till Sunday. Because you and I both know that I can create 18 packages for lending, and I can tell you, look, lower interest rates, higher points, lower points, higher interest, do it this way, do it that way, an adjustable, a fixed, whatever. So they never should have even done this, but they did. So we've gone from a HUD, which now everybody understands because we spent 20 years explaining it to clients, to something called a CD. They think it's a CD, you know, like a CD like Beyonce singing. It's a closing document that is now 6 pages long with all kinds of information. That's what this is all about, guys. These poor banks are on 7 different platforms trying to give the government financial data and being penalized against time frames. And the whole point of it is the government wants data on you, on me, what we're buying, what we're selling, who's doing what. That's what this is all about. So now the banks are basically required to live with these time frames. So are you. They're penalized enormously if they don't mandate the time frames. So now you're getting into a deal with a client. The first thing I think you need to say to them is, well, my friend got theirs closed in 20 days and we would like that too. No. 20 days probably isn't going to be possible while everybody's adjusting to this new system. It's probably going to be closer to 30, 35 days. That's the way it's going to be. And when somebody in the mortgage lending business says we can close it in 20 days, don't do that. I just don't see it. And what happens is they promise it and they're over-promising to you and they can't deliver because it just doesn't work. It may work for them. They may know what they want to do, but with the banks, the clients, the time frames, the disclosures that are needed, the information, it doesn't happen. What you need to do is rethink how you've done the process of doing a contract and getting this deal closed. Because what we used to do is start the process, get the lender information, and we added things as we went along. So you did an inspection and a home warranty and insurance, etc., etc. You now need to get everything into the lender. Everything you can possibly think of that you're going to need on this property. And when a client says, don't worry about the insurance because we have a broker, you need to say to them, then I need to know you've got that policy today. Because otherwise we're going out and getting one, because here's what happens. If anything changes, once the clock starts ticking, it goes back to square one and the clock starts ticking again. So you're 10 days into this process and you say, oh my God, we need to have a JCP or a home warranty or this kind of a report. Guess what? You've got to go back now and the clock starts ticking. You just wasted 10 days. Now you get to the end of the process, and they've changed that also. Buyers and sellers now have to wait 3 days after they've looked at the CD, gotten it, verified its correctness, agreed that they will sign it before they can assign it. So now you know what happens. 3 days. That's called buyer's remorse. You do know that. They'll love it on Friday and hate it by Monday, but that's the new mandate. And buyers and sellers both have to sign, and sellers probably have to sell before buyers, and the banks are mandated as to how they get it to them. If it's by mail, they get 6 days. If it's electronically, they get 3. I mean, there's all kinds of weird things that are going on here. Now, the last thing is about title. Let's talk about title. Title has always been optional, but nobody ever realized that. But now it must be disclosed to your buyers and sellers that title is optional. Now the problem with that is you're going to have a bunch of people who are going to say to you, well then I don't need to have title. Yes, you do need to have title. We had 14 million homes that were in foreclosure and short sale. Now that means that we don't know who was on title, because half of them were Mickey Mouse. We don't know basically who was there, who wasn't there from a foreign country. Oh, somebody gets divorced, but they don't take one person's name off of it. Now it goes through. You didn't clear title. 2 years later, you go to sell the property. That person does get a title report. All of a sudden, you don't own the property yourself. You own it with somebody you don't even know who was divorced 5 years ago. Now you got to go to court. Now you got a problem, because it's going to be 6 months in the court before we get it all cleared out and we find Susie because she's not around anymore. And now you have a seller who bought a property who's in trouble, a buyer who can't move in and they sold their house, and now you got a lot of lawsuits. Now everybody says to me, but Carole, the lender will require it. Yes, the lender will require it, but that policy only protects for liability the lender. It will tell you who's on title to the best of their knowledge, but it's not going to protect the buyer or the seller for liability. So here's what the title companies are doing. They sort of readjusted, like a First American, they've sort of readjusted their cost structure. So now if the bank has a title policy and you have a buyer that needs a policy, they bundle them together because one will mirror the other, and your buyer gets a discount on their side. So they're probably only paying $300-400 for that policy, and they need it because they need it not to tell them who's on title, because the lender policy will, but for insurance in case something comes up at a later date. So I think that's very important. Now, where do I think that it's going? Let's talk about that. I think you're going to have appreciation. I think it's going to be more mild. I think this market is going to get a little bit spongy. Now, we talked about sticky. Will it stick? They're watching. That's what it has to do. It has to stick. So we have to do things with sellers to enhance buyers to come back out from the fence and get back into the buying mode. Why do I say it's spongy? Because sponges take in and give out, and that's exactly what I'm seeing. Some of the markets are working extremely well at the lower end. Some are giving back a little bit of what they earn. Now here's the last thing you need to tell sellers. Mr. Seller, let's go back 5 years, all right? When you bought your property 5 years ago, or even if you've lived here 20 years, let's talk about what price it had at that point in time. Now let's move forward every year, and let's look at how much appreciation you have gained in the last 2 or 3 years. So now what you're doing and what you're telling me is you've gained this much appreciation in your property. Now it's time to sell it. Either because you're going to move up, you're moving around, or you want to retire and go someplace and take all that with you. So now what you're going to do is you're going to outprice yourself in the market. You're going to not get the attraction of the buyer, and you're going to do all that to try to get this much more. That's a foolish thing to do. And here's the other thing you need to understand, Mr. Seller. Interest rates are going up. And especially at that first time lower market, that will make a difference to buyers. That 0.25% probably will make a difference. So look, I think you have a great market. See, I think these are buying opportunities. I think people should be buying real estate. I think, imagine, you're not buy Disney, you're not going to buy GE, you're not going to buy Costco, you're not going to buy Netflix. And when I got up early this morning, I was watching all these stocks as I was looking across the board, and they're bringing them all down like crazy, like $4 or $5 a shot. And I'm thinking to myself, is this crazy or are we all crazy? So at the end of the day, remember what Mr. Buffett said. Mr. Buffett, the second richest man in the world, said, I see these kinds of things as opportunities to buy. I never want to buy when everybody else is buying and everything is high. I always want to buy when everything is low and nobody wants to buy. Because he said, I know one thing. 10 years from now, when I look at my real estate and when I look at my stocks, they're going to be worth a hell of a lot more than they are today. And that's an 85-year-old man talking. So he thinks when he's 95 and he's still here, all his portfolio is going to be worth a hell of a lot more, which is good. All right, so that's what I think we know about the economy, what we know about real estate. So let me close with kind of a cute story. I think I have one that's kind of cute. I always talk about the grandchildren. And I talk about the little one, the redhead, the terrorist named Jameson, who I always said if we sent her to the Middle East, she could solve that problem in about 2 months because they would sign any treaty to get rid of that kid and send her home. And she is a little, she's just so aggressive. And she's had a speech problem. And when she was 2 years old, she babbled constantly because she's a big talker, but nobody could understand what she was saying. And she used to get really frustrated about that. And she would say, I told you that. And we would say, I know, but we don't know what you're saying. So of course, you know, in today's world, you have to send these kids to speech therapists and psychiatrists, and they got to go to gym and ballet, and you know, they got to have the braces on the teeth, and oh my God, we got to do everything to make them perfect. So we schlepped down to the speech therapist, of course, at $100 an hour, and she insists upon seeing the whole family. And so I go one day, and she's interviewing me, and she says to me, now, do you understand the word phonics? I mean, like I'm an idiot, right? And I said, I think so. And she said, well, let me explain to you how it works. So I didn't want to tell her I speak for a living because I figured, why should I bother doing that, right? So I sit there going through this didactic teaching of phonics, which is when you basically sound out words for children. And she said, the problem that your granddaughter has is that she may hear it correctly, but it doesn't come out of her mouth correctly. So what I would like you to do is when she makes an error, to stop then and correct her, because we don't want her to think that she can do it sometimes and sometimes she can't. Okay. So we're in Walgreens the other day, and she picks up this little dog with the big eyes, I don't know, these little dogs they like, and a stuffed animal. And she says to me, Nana, can I have the dog? And I said, sure you can, honey. And we're going up to the counter, and she says to me, Nana, what is the name of my dog? And so I said, the dog's name is Rex. She says, no, Nana, it doesn't work like that. She says, my dog has a name, it's on the label. Oh, big deal, then I know a stupid dog has a label. So I look at the label of this dog, and I can't believe it, because they have called this dog Iona. Now, would you name a dog Iona? No, you would not, and I have no idea what that is. It must be PC correct or something. So now I'm talking to the kid, we're in line, and there's like 14 people behind us, and I said to her, Jameson, the name of your dog is Iona. And she says to me, I got it, Nana, Kahona. No, Jameson, I said, it is not Kahona. The name of the dog is Iona. She repeats it back the same way. Now I got to go into phonetic mode, right? And people are looking at me like, this woman is whacked on something we should call child abuse. So I'm saying to her, see, you're going ka, and you need to go I. And I'm saying that, and this little tiny thing just keeps looking at me and doesn't say anything. The third time I did that, she looks at me and she says, oh, just forget it, Nana. We're going to call this dog Winnie. And so I got out and I called my daughter and I said, good for her and so much for the $100 an hour therapist. Because what this kid figured out already is, I don't have to call it Iona. I can name this dog anything I want. So therefore, she's going to own the world. That's a good thing. All right, guys. Happy holidays. You know how you get along with, you know how you get along with family in the holidays? You just agree with them, then go home and do what you want. Happy holidays.
Thank you, Carole.